Hello, welcome back. It is your Loan Depot with Night Grills, and this week for our Wednesday morning coffee talk, we have a politically charged topic, right? You've probably read the headlines, you've heard something about the new changes to conventional loan pricing. It's kind of billed as that higher credit score borrowers would pay more, and those with lower credit score would pay less.
For the same interest rate.
For the same interest rate, yeah. And so basically what this is it's a change to the LLPAs. So let's start there. What is an LLPA? An LLPA is a loan level pricing adjustment. And those were introduced back in 2008 to help better match up the risk of a loan with the pricing of a loan. So prior to 2008, whether you're putting down 10% or 20%, you got the same interest rate. If your credit score was 720 versus if your credit score was 660, same interest rate. So after 2008, they came in and they made adjustments based on loan to value, credit score, the loan purpose, are you purchasing or cash out refinance, occupancy, will you live there or will it be an investment home? Investment properties have a higher risk of default than primary residence. And the number of units, is it a single unit, duplex, fourplex, that type of thing. And actually coming up, they're going to make an adjustment for debt to income ratio, but that has not happened yet.
Right. So basically, it's risk-based pricing.
Correct.
The new ruling will reduce the loan level pricing adjustments for lower credit scores or lower down payment buyers, while slightly increasing the cost or the LLPAs for people with higher credit scores, same down payment, basically. In essence, we're narrowing the gap. The interest rate for the same interest rate, the cost is going to be less between a low credit score buyer and a higher credit score buyer, basically.
Right. So LLPAs have been around for a very long time. So this new change as of May 1st, what it did is, for example, a month ago, it may have cost someone with a credit score of 620 2 points to get a rate of 6.875. So 2 points, 2% of the loan amount in cost. And that same scenario with somebody with 780 credit score might have only paid a half a point to get 6.875.
Yep.
Now the 780 is paying a point instead of a half a point, and the 620 is paying 1.5 instead of 2.
Yep.
So it's not that these just automatically came out of nowhere and only high credit people are impacted.
Right.
They've just again
narrowed
that gap.
Just narrowed the gap. Right.
Yeah. Exactly. So I mean, I think it's important to point out that this is not lender specific. This is every lender is impacted by these who works with Fannie Mae and Freddie Mac, the government agencies. So this is a ruling from the top down. There has been an act imposed in government.
Introduced, yes.
Introduced.
Because
I
think,
oppose it.
Well, what we were talking about is what are the unintended consequences that might come from this, right? And we've had borrowers, and you maybe have had buyers come to you and say, well, I'm just going to do something to lower my credit score so I get a better interest rate. Which isn't that. Yeah, that isn't how it works.
No.
You just don't get as good of an interest rate for having the higher credit score as you used to get. Right. So some people in Congress do think that this is unfair. So there was a bill just introduced last week called the Responsible Borrower Protection Act. So we'll keep you posted. Yeah, we'll see what happens if these stick or not. But yeah.
So join us next time for our Wednesday morning coffee talk.
Cheers.
Cheers.